So Kelly is a senior portfolio manager with our Broadway Wealth Management Group. She's got more than 25 years of experience in our investment management. She's got a slew of professional designations, that's all those initials after that. So CFA, Chartered Financial Analyst, CMT, Chartered Market Technician, and CFP is Certified Financial Planner, and soon she'll be adding PhD after that. She'll be wrapping that up closer, I think, to the end of the year. So, and that's in International Economic Development. So we've got a real smarty pants here to talk to y'all today. And I'm gonna give you two fun facts about Kelly before I hand over the mic. Her husband, Darren, retired from the military after 22 years of service in the Army, and now he works for the DoD. And her favorite hobbies are traveling internationally and reading, so she's taking suggestions if you've got any good books for her trips, okay? So please welcome Kelly. Thank you so much.
Good morning, and thank you for that introduction, Casey. I'm glad that someone outside of my mother thinks I might have something worthwhile to say. What I'd like to do this morning is take maybe just 25 or 30 minutes to offer you some comments about the markets and the economy, and then I thought after that we would take some questions and answers if that works for you. Before we jump into that, I'd like to talk a little bit about politics and labor, or give you a story about those two topics, because those two topics will feature prominently in our discussion this morning. So, 3 contractors are bidding on a government project, and those contractors come from 3 different states. The guy from Minnesota looks at the project, gets out his measuring tape, and he bids $700. That's $300 for materials, $300 for labor, and $100 for him. Now the guy from Minnesota does the same thing. He looks at the project, he measures, and he bids $1,000, which is again $300 for materials, $300 for labor, and $400 for him. The guy from Illinois leans over, whispers into his congressional representative's ear, and he says his bid is $2,700. And the representative says, how on earth did you come up with that without measuring or doing anything? And he said, well, that's $1,000 for you, $1,000 for me, and $700 to hire the guy from Tennessee to actually do the job. So that's about as hard as the math is going to get this morning, but I hope the jokes will get a little bit better. Sorry, we're having slide problems here.
Here comes the toucher.
All right, there we go.
There we go.
Turning to the serious material, the wild economic swings that we experienced in the economy, in supply chains, and in unemployment during the pandemic have largely subsided at this point. Expectations for U.S. economic growth are 2.1% this year, and another 2% next year, and 2% the year after that. That comes after 3.1% economic expansion last year in 2023. Not only is that not a recession, that's actually very strong growth. The 4 main groups that contribute to economic growth in this country are consumers, what you and I buy, businesses, what they invest, what the government spends, and net exports. And net exports are the things that we buy from abroad versus what we sell abroad. Now, consumers represent 70% of our economy, so what's happening on Main Street really drives what's happening at the top of the house. And consumers are slowing down their purchases. They've spent all of their COVID-related spending. Prices are going up for things like houses and cars, and prices are going up to insure those things as well. Retail sales are softening, and bankruptcies are going up a little bit. So what we're seeing is that consumers are pulling back a little, but it's nothing dramatic. This is really just a typical normalization. With regard to business investment, we've now seen 9 consecutive quarters where businesses have increased their investment. This is because of infrastructure spending incentives. It's because of deglobalization, or friend-shoring, as people say. It's because of changes in the supply chain and investments in things like artificial intelligence, among other things. The government, the third group that impacts the economy, is slowing down. They're not sending the stimulus checks that they had been in the past, but we expect that to be a net positive for economic growth. And of course, the strong dollar is allowing us to buy more from abroad than we sell. And when that happens, that represents a little bit of a negative with regard to our economic growth. So over overall, the story with regard to the economy is that things are strong, but we are probably past our peak for this business cycle. We also like to keep our eye on the labor market because if people have jobs, then the consumer has money to spend. And unemployment is very, very low by historical standards. We've actually had an unemployment rate in this country of 4% or lower for the last 30 consecutive months, and that's atypical. The Fed's projection for unemployment is 4%, so we're right at what they see or expect rather. But payroll numbers were pretty strong last month. In May, we created 272,000 jobs in this country, and that caused some jitteriness in the market about maybe the employment picture being too hot. Two of the biggest sectors for job growth have been in construction and the leisure hospitality sector, and those tend to be the sectors that hire the most low-skilled labor. But if you peel back the onion, the length of unemployment has been increasing, and that's inconsistent with those low unemployment numbers. If the market was that strong, you would think that people who want a job could get one just like that, but it's taking them longer and longer to do so. As of last month, however, there were 8 million job openings in this country. That means that for every single person that's out of a job, there is 1.2 jobs available for them. Still, that's down a little bit from a high of 2 jobs per unemployed person just recently, but if you don't have a job right now, it's because you don't want to work. My goodness, we have 2 octogenarians in DC fighting it out for 4 more years of work, right? To reiterate, there are jobs, therefore people have money to spend, but salaries aren't going quite as far as they used to because of this phenomenon that we know of as inflation. Do you remember the old saying, a penny for your thoughts? Well, that'll cost you at least $1 in this economy when prices have increased. Annual inflation is actually about 75% lower than it was at its peak exactly 2 years ago in June of 2022 when it peaked at 9.1%. What's the Fed's target for inflation?
0.
2%, and I do have some surprises for anyone who answered that. What's inflation now? That's the harder ones.
3.1.
3.3 was the last one I saw, so very good answer. The Fed actually looks at an inflation measure they call personal consumption expenditures, and that tends to be about 1/4 to a 1/2 point lower than the consumer price index. That PCE number is coming out this Friday, so keep an eye on that because that will give us an indication of what the Fed may do going forward. Now, as far as producer prices are concerned, the last release that we saw there was that producer prices were up 2.3% over the last year. That's less than the increase in consumer prices, and that's a good thing. That foreshadows pretty good inflation going forward because if companies aren't paying more for input prices, they don't have to increase their prices to the end user. And again, that's overall a good thing for the inflation picture going forward. So generally, the story is that inflation is going in the right direction, but we're not out of the woods. Just like it's hardest to take off that last 5 to 10 pounds, that last little bit in getting from 3.3 inflation, 3.3% to 2% may be the hardest. By some measures, inflation may actually be stalling. Goods inflation, or the prices that we're paying for things that we can touch and feel, like appliances, for example, that's pretty much back to where it was before the pandemic. But if you look at services, which accounts for 60% of the inflation basket, that inflation rate has skyrocketed. And that's a function of wages going up, or minimum wages going up in many states. So this environment may make it tough for the Federal Reserve to cut rates. Regarding inflation, someone once said, "I have enough money to last me the rest of my life unless I buy something." So, what are some ways you could protect yourself against inflation? Well, of course, if you don't want to stop eating, driving, or buying stuff, then another option is to buy stocks. And the reason stocks are a natural hedge against inflation is because companies that have pricing power can pass on those higher prices to end users, and their earnings stay high, and therefore those stock prices go up. And earnings, as I will repeatedly say, are what drives the stock market over time. Second, real estate and related investments like real estate investment trusts also hedge against inflation. And the other good thing about REITs, as we call them, is that by law, they are required to distribute 90% of their income. So they also give us as investors a very nice income stream. Third is that commodities and gold in particular also increase when prices increase. So it's no surprise that gold prices have recently hit all-time highs. Now, inflation and interest rates go together like pencil and paper, peanut butter and jam, and apples and pie. After increasing about 1/3 of a percentage point during the first quarter of the year, the benchmark 10-year US Treasury is now right around where it was at the end of March, about 4.25 or 4.30. As yields go up, what happens to bond prices? They go down, exactly. So this increase in yields that we've seen over the last couple of years has been terrible for bond prices. But that only matters if you trade bonds. If you buy bonds and hold them to maturity, like people often do with CDs, then you're able to enjoy rates that we haven't seen in almost a couple of decades. So it is a very interesting interest rate environment. Another interesting part of the bond market is this difference between the yield on 2-year treasuries and 10-year treasuries. Normally, when you buy a longer bond, just like when you buy a longer CD, you're taking more risk, so you get a little bit more return or yield for that higher risk. However, shorter treasuries have been paying more than longer term treasuries. And in investment speak, we call that yield curve inversion. And the reason that yield curve inversion is important is because that phenomenon has predated every single recession that we've had in this country in the post-World War II era. The difference between 2 and 10-year bonds was over a percentage point a year ago. Now it's down to about 0.5%. So we are on the way towards normalizing, and the economy remains strong. So things may well be different this time, meaning we may well have averted a recession. The reason things are different is that we were in a period of abnormally low interest rates, and we're just coming out of that post-pandemic. So that man-made environment is what made things unusual, and it may well be the reason that we don't see a recession despite that yield curve inversion. So the economy is fairly strong, people are employed, inflation is coming down, but interest rates remain high. That leaves the Federal Reserve in a tough situation. They have just 4 more meetings left this year, and they really don't need to cut interest rates to make borrowing more accessible, because they don't need to stimulate the economy certainly if we're not going to get a recession. Yet, the market is expecting 1, if not 2, interest rate cuts yet this year. And in fact, there's a non-trivial chance that they may stay flat, meaning they may not change rates at all, or they may even increase rates, and that's a very new development. I would argue that the single biggest economic risk that we have out there right now is probably inflation rearing its head. And that would really leave egg on Jerome Powell's face. And Jerome Powell is, of course, the head of the Federal Reserve. If he cuts rates too soon and he has to turn around and increase rates, that won't look good. That's not great for job security. And don't think that just because it's an election year that the Fed won't act. Because if you go back to every single election since 1980, the Fed has changed rates in all but 1 election year. And they have raised rates as many times as they've cut rates. The Fed has also been reducing its balance sheet to the tune of $110 billion a month. The calculus behind that means that there's less demand for US Treasuries and arguably higher yields as a result. Now, we see a lot of headlines about the Chinese and the Japanese central banks potentially selling their pools of US Treasuries. I would argue that the US bonds that the Fed owns are much more of a factor in what happens than anything the Chinese or the Japanese do. And the reason is that the Fed owns $7 trillion worth of bonds. The Japanese own 1.1 trillion, and the Chinese own 800 billion. So by order of magnitude, the Fed's actions are much more important. Lastly, with regard to the Federal Reserve, if Trump wins in the fall, you can expect that Fed Chair Jerome Powell will probably lose his job when his term ends in 2026. And that's a little bit of an ironic development because Trump did appoint Powell to replace Janet Yellen. So again, interesting twist. Stay tuned for more there. I put a slide in here about oil because we are in Texas after all. And crude prices have generally traded in a range. Believe it or not, crude prices are right back where they were 10 years ago. So despite volatility, despite all of this talk about what OPEC is doing, whether we should export, how we are putting crude into the Strategic Petroleum Reserve, prices have been remarkably stable. Crude and commodities are generally priced in US dollars, so we like to keep our eye on what's happening to the US dollar. And with interest rates in the US fairly high compared to other countries, people from abroad have been selling their currencies and buying US dollars in order to invest in the US bond market. And what that does is put upward pressure on the US dollar. So the impact for you outside of your portfolios is that if you have been planning a trip abroad, this is a great time to buy some foreign currency because your dollar will buy more than it would have in the past. Questions about the economy before we jump into the markets? All right. The total return of the S&P 500 year-to-date as of Friday was about 15%. What's typical for an average year? What's a typical return for the S&P 500? I heard somebody say 9 to 10%, exactly. I want you to remember that because we're going to come back to that again and again and again. So we've gotten 15% in the first 6 months of the year versus an average of 9 or 10%, which means we've gotten a year and a half of returns over just 6 months. That's a healthy return. Will stocks continue to increase from here? Raise your hand if you say yes. Ooh, so it looks like there's a lot of no's in the room, unless y'all are abstaining. The interesting thing about not just the US market, but the global markets is that the markets have been very narrow this year. And what I mean by narrow is that there are just a few stocks that are giving us massive returns, while the rest of the market is just kind of so-so. Exactly. The 5 stocks, just 5 stocks have been responsible for almost 10% of that 15% return so far this year. That's atypical. This chart talks about the top 7 stocks, or the Magnificent 7, as you may have seen in the headlines. What the green line shows is those 7 names have gone up much more than the other 493 names in the S&P 500, and those 493 are represented by the blue line. The chart on the top shows earnings for both the Magnificent 7 and the rest of the market, and you can see there that those Magnificent 7 companies, as they're called, are earning. So the question you might be asking is, well, why don't we put all of our money in those 7 stocks and just forget about it? And the answer is because things are changing. One of those high flyers, Tesla, has lost money this year, and others have gone up so much that they can't continue to increase at this pace. So this is a great time to have someone look at your portfolio to make sure that you are positioned for what we expect going forward, not what's happened in the past. Does that make sense? Okay. Has anyone heard of the company NVIDIA? What's that company do?
AI.
Exactly. It's a technology company that makes semiconductor chips that are used in artificial intelligence. And if you do a Google search, that takes 10 times less power than it takes to do a search on ChatGPT, which is a type of this generative artificial intelligence. So there's huge demand for these chips made by NVIDIA. How much is NVIDIA stock up so far this year? 180%. Somebody got it spot on as of Friday. How much does this S&P typically go up a year? How much did we say? 9 or 10%. So NVIDIA has given us 18 years worth of return in just 6 months. Do you own that stock in your portfolio?
Yes.
Good. My point here is that this is not a market where you can just buy a bunch of stuff, put it in your portfolio, and forget about it. There is a huge difference between what's working and what's not working. There are 11 subsectors in the S&P 500. How many of those have generated a year-to-date return more than the S&P 500? Meaning, how many of those have generated returns above 15% year-to-date? Just 2. Just technology and communication services. So that means 9 sectors are underperforming the S&P 500. Now, we always look at the valuation of stocks to see whether they're cheap, expensive, whether this is a good time to invest. And the forward price earnings ratio, or the price per pound for stocks, as I like to think of it, is 21 times right now. So that means for the price that you pay for buying the index, it will take 21 years to earn back that price in the form of earnings. Sounds like a lot, but the average is closer to 16 or 17 times. So stocks are a little bit expensive, but not a lot. People often ask if we're headed for another tech bubble like 2001. Remember that? My answer is absolutely not. And the reason I answer that way is because those price earnings ratios are not nearly as high as they were during the tech bubble. Secondly, during that period, stocks were moving based on sentiment, not earning. And we just saw that slide up in the corner showing, or that chart showing, that these companies are earning money. So that's a big difference from what we saw back in the early 2000s. The companies whose stocks are moving the most are those companies that do earn the most. So valuations are a little stretched, but that's primarily a function of tech stocks. And if you look at things like dividend paying value stocks, their PE is only slightly above the long-term average. If you look at small stocks have been relatively flat this year versus a 15% return in the S&P 500. Small stocks have not had an all-time high in the last 2 years versus some 30 all-time highs in the S&P 500 this year alone. So they're interesting long-term. International stocks arguably have much more runway than some US stocks. So the long story short here is that stocks have done very well on average since COVID, but not all sectors have enjoyed that return equally. Since the March 2020 lows, the S&P 500 is up an average of 25% per year. What's more typical? 9 to 10%. Good, you guys are getting it. And that 25% that the S&P has given us over the last 4 years, that's with an 18% drop in 2022. So what we're talking about with clients, because this is not a normal environment, we are talking about risk management and how to protect the downside in portfolios. One thing that we're not trying to do is to time the market. And the reason we're not is because stocks give us 9 to 10% a year. But the average retail investor, like you and I, we earn just 2 to 3% on stocks because we try to jump in, jump out, pick the right stuff, and it doesn't work. Another reason we don't time the market is because more often than not, the best days in the market happen during bear markets. You only have to go back to March of 2020, again to the beginning of the pandemic, to see how that works. And what happened there was the S&P dropped 15% over a week. On March 24th, it was up 10%. So if you had gotten back into the market just 1 day late, you would have missed a year of return. So timing does not work. So they won't let us discuss religion or sex during these presentations. Therefore, we are going to pivot to politics. I understand politics comes from the Greek word poly, which means many, and the word ticks, which means little insects. Isn't it sad that we get 50 choices for Miss America, but we have just 2 choices for the leader of the free world? When it comes to the November 5th election, Republicans have a Trump card, but Democrats are just biding their time. I told you there were going to be some dad jokes delivered by mom. In this highly polarized economy that we live in, it's no surprise that just 13% of people who lean towards the right think the economy is strong versus 50% of Democrats. It's anybody's guess who's going to win in November, but a strong economy does tend to be good for the incumbent, yet we are a long way from November. Some people ask if a third-party candidate might be able to make waves in this election, and to that I would just quote what someone said at the White House Correspondents' Dinner recently, and that's that, just like his vaccine card says, Robert Kennedy doesn't have a shot. The biggest mistake you can make in this market is overestimating the impact of the election on the market. Over the long term, what drives stock prices? Earnings, yay, A+. That said, this election is important, and it is a little different for 3 different reasons, in my opinion. First, is that the individual tax cuts that Trump implemented in 2017 are set to sunset at the end of next year. So what that means is that if Congress does nothing, the estate tax bracket and the top marginal income tax bracket will revert to where they were in 2016, meaning the estate tax exemption will fall by half, and the top marginal tax rate will go back to 39.6%. Of course, Congress can make a change to implement a law to make this permanent, but if the opposite of pro is con, is the opposite of progress Congress? Not holding my breath on taxes. And the second reason this election is important, and another reason I'm not holding my breath on taxes, is because of the national debt. How much debt do we have right now? $34 trillion. To put that in perspective, it took our country 200 years to amass the first $20 trillion of debt, and it took us 14 years to amass the other 15 trillion. So we have generated roughly 40% of our overall debt over just the last 14 years. And that's thanks to both parties spending like there's no tomorrow. Republicans knock the Democrats for their social programs, Democrats knock the Republicans for their tax policy, but whether you're getting a stimulus check, a tax cut, a veterans bonus, a welfare check, or Medicaid, it's all part of the same bucket. It all comes from the government. It's just packaged a little differently depending on who's talking about it to make us feel better about it. So because of that lack of fiscal restraint on the part of both sides of the aisle, the level of our debt to GDP is now 130%. To put that in perspective, the academic studies tell us that anything over 90% is a failing grade. And the reason it's failing is because once we get over that 90%, we have to use so many of our tax dollars just to pay interest on that debt that we can't spend it on other things to help support the economy. So the economy tends to grow more slowly in that environment. I may have shared this with you before, but how long does it take to pay back $1 trillion of our debt if we pay it back at a pace of $1 per second? It's about 32,000 years. And we have 35 trillion. So if you do the math, that's 1,088,000 years. Needless to say, I don't think taxes are going down anytime soon. As Herbert Hoover said, blessed are the young, for they shall inherit the national debt. The third reason I think this election is important is because there is no serious discussion about Social Security or Medicare reform. And as you're probably aware, both of those systems are facing insolvency within about a decade or so. So by the time our next president finishes his term, these two systems will be in absolute crisis. Now, under both candidates, the deficit will likely widen from here and inflation will likely increase because of the broad spending that both candidates espouse. If Biden wins, expect less policy uncertainty and therefore less market uncertainty just due to a continuation of the status quo. If Trump wins, expect protectionism, tariffs, and trade wars aligned with Trump's America First agenda, and there will probably be a little more volatility under that scenario. Under Trump, limited immigration will also put upward wage pressure on sectors like construction, leisure, and services, and that's simply because those are the sectors that tend to hire the most immigrants, and they're the most wage sensitive, meaning more of their inputs come from wages than widgets. What I want you to remember is this: it's earnings. Earnings that determine whether stock prices rise or fall, not the man in the White House. In other words, what happens with things like interest rates and how easy it is for companies to borrow and therefore invest in the growth of their business matters a whole lot more than the outcomes that Trump or the Biden administration might implement. Again, it's not the guy or the party running the country. Having said that, I'd encourage you all to stay up after our bedtimes tomorrow night to inform ourselves about potential policies during the first presidential debate, but I would discourage you from letting your politics drive your investments. Question: did the stock market do better under Obama or under Trump? It's a trick question. The returns were identical. The returns were 16.3% per year on average. And that was much more a function of abnormally low interest rates in both cases than anything either gentleman did. Elections breed uncertainty, and that certainty breeds bigger swings in the market during election years. However, if you go back to 1932, the market has been positive 78% of the time between January 1st and Election Day. Frankly, that doesn't tell us a lot because 3/4 of the time, stocks are up anyway. If you look at the average return over that period, it's been 5%. That too doesn't tell us a lot because it's been as low as negative 30% when Obama was elected, and as high as positive 30% when Roosevelt was elected to his second term. Now, after the election, the data is just as inconclusive, except that once the election happens and the uncertainty is eliminated, the market knows who is going to run the country. The stock market tends to deliver us positive returns in almost every case in that last 2 months of the year. So we've talked about what happens before the election. We've talked about the last 2 months after the election. So what happens during the presidency? And when you look at just the return for stocks and compare the party of the president to the return on the S&P 500, we tend to get about 8% a year for Republicans, so more or less in that average zone. And we get about 15% a year for Democrats. But those averages don't tell us much either. You really need to look at under the hood, and you need to look at the makeup of Congress to see how the stock market will react. It's more than just the presidency. It's how those parties are represented in Congress and whether the administration can push through the major policy changes, as you probably are aware. When there's a single party in power, more big legislation tends to get approved, and that tends to be more disruptive. But that's only happened 40% of the time in the past. More often than not, 60% of the time, we have a divided government. And that split between the party of the president and the parties that make up the Congress is really the best case scenario for stocks. That's the environment where we get strong double-digit returns no matter what party is sitting in the Oval Office. As a practical matter, there are 6 swing states that are probably going to determine who the next president of the United States will be. And the bottom line for the stock market is that stocks will tend to go up regardless of who's elected. So the historical precedent is to be optimistic about stocks no matter what happens in November. Again, the biggest mistake that you can make is investing based on your mood. The best way to invest during an election year has rarely been to sit on the sidelines and put your money in CDs. So don't let a short-term event like this election impact the long-term returns of your portfolio. If you want to express an opinion, do so at the polls in November. Again, the markets tend to do very well under any configuration of government. Finally, there's a lot going on with regard to geopolitical issues outside the United States. The trade war with China, as we hinted earlier, was not addressed. It kind of faded to the background with the pandemic, as did the issues with North Korea, South China Sea, and depending on how the election goes, those issues may heat up a little bit after November. There's also the war in the Ukraine that's a problem that the U.S. is increasingly unwilling to fund. So what happens given that the U.S. is facing war fatigue and they're pulling back on support for Ukraine? Who's going to pay for rebuilding Ukraine's infrastructure? These are all certainly national security issues that could very well impact the U.S. economy and the markets. The Middle East is obviously very sensitive, but it's far less economically important just because of the size. With regard to geopolitical issues, remember this. I don't mean to diminish their importance, but there are always things going on. Warren Buffett reminds us that in the 20th century, the U.S. has endured 2 world wars, other traumatic and expensive military conflict, the Depression, a dozen or so recessions and financial panics, oil shocks, and the resignation of a disgraced president, yet the Dow rose from just 66 to over 11,000. And there's no reason we shouldn't expect that going forward as well. So there's a lot going on out there, but investors are being handsomely rewarded. What matters for the stock market is earnings, and earnings are now solidly out of a little earnings recession we saw in 2022, 2023. So over the short term, while the market could be bumpy, we're confident that investors will be very happy investing in this environment. Questions?
I will bring the mic to you. A question. I'm a coming.
involve the actual inflation? What part of the inflation does shrinkflation incorporate?
That's a good question, and I think you're getting at how what started in the toilet paper industry, believe it or not, with a term called shrinking, is impacting prices. And that's where, you know, if we've got, I don't know, 100 sheets of paper towel in each paper towel roll, now they're giving us 95 and they're charging us the same price. That doesn't get calculated into the inflation numbers the same way that charging us 5% more for that product would. So that's an area where inflation is impacting us, but the Fed's not necessarily seeing that overtly in the numbers. Good question.
I'm coming. This is why I wore flats today.
I would say that some of that is offset by things like technology. You know, I remember taking my first plane trip when I was 16 years old. That ticket to Europe cost me $550. I just purchased a ticket for my daughter to go to Europe, and that ticket cost $550 a minute later. So, you know, while inflation has gone up over the last 30 years, there are places where we're seeing prices and the opposite of shrinking. We're getting more for our money.
Appreciating the raw and obvious financial issues that you described, ARC does not recruit 35 to 45-year-old people to live here in the facility. And the life tables reasonably impact our individual viewpoint of our portfolios. That's not been mentioned so far, but if it's death and taxes, well, it might have to be considered. And I'm just saying that's a viewpoint that the people in this room are, I think, keenly aware of if you ask them.
I get that question a lot, and I thank you so much for asking it. My apologies for not addressing it up front. So the question is, you know, we talk about long-term views for stocks, but if your life expectancy isn't long, what do? The long-term time frame for stocks matters. If you are living from your portfolio, that's the only source of income that you have, and you expect to fully deplete your portfolio by the time you or your partner passes. In most cases, my experience is that that is not the situation. I would argue, or I would think, that everyone in this room probably has Social Security. Many people probably also have some veterans benefits, if not some disability benefits. So there are often other sources of income that you're not relying on your portfolio for. What I see in many cases is that people have saved very well. They've amassed a source of wealth, and their intention is to leave that to their children, grandchildren, charity. Some people leave it to their pets even. But that pool of money is meant to last beyond your lifetime. And if that's the case, then you don't necessarily have to correlate your lifetime and the lifetime of your portfolio. Does that make sense?
Yes, ma'am. Should the majority of the folks here have, like you said, Social Security and pensions and things of this nature, but a lot of us may have that we have to take RMDs every year, required minimal distributions from our traditional IRAs, SEP IRAs, etc. Do you have an opinion on when's the best time to take these RMDs? Beginning of the year, end of the year, monthly, biannually? And what do you invest that in order to have some type of income? Sometimes we use our RMDs to take charitable distributions and help lower some of our taxes. Do you have any information about that and your opinion? Thank you.
Good question. The best time to take RMDs is when you need them. If you don't need them, people like to take them towards the end of the year, because if the market goes up 3 years out of every 4, the probability is that you'll have a little bigger portfolio. It'll make a little less of a dent if you take that at the end of the year. But if you need the money, people often take it quarterly or monthly. And what I see a lot of people do, if again, they're savers, they don't need this money, they just need to pay taxes on it. They can distribute up to $100,000, I believe, as a charitable contribution, and you won't have to pay taxes on it. Or you could just put it into a taxable account and continue investing like you had in your IRA.
coming, see, I walked on the other
Vanna
side.
White is on her way.
I'm not in an evening gown, unfortunately, maybe next time.
Most of us were invested with USAA. USAA went and transferred or sold their management over to Schwab. What are your management fees for an account, please?
Casey's.
I can handle that. That's me. So our fees depend on the type of account, and that correlates with really the role that we serve. So what I call a plain old investment account, where we just serve as your investment agent, you make all the decisions, distributions, that sort of thing. That includes IRAs. That starts at 1.25% a year. Okay, and that's on the first million. So the more that goes in the bucket, the fee will stair step down. Does that make sense? So if, for instance, if there's an irrevocable trust where the bank serves as trustee and we have to file tax returns and make distributions and keep track of all the beneficiaries, that's a little bit higher. That starts at 1.4% per year. And it's charged monthly the following month. So July 8th, we will charge for June, and it's based on the fair market value of the account the last business day prior month. So we ride the market with you. We don't say, oh, we're gonna take the average, because there's a bank in town that does that takes the average
I would
and
argue,
takes their fee on that.
sorry, Casey.
No, go ahead.
I just wanted to jump in and I would say, I would argue that our fees are right smack dab in the middle. You can find some considerably more expensive, you can find some a little less expensive. But one thing that I know that we do that Schwab doesn't is we pay 5.25% on our cash right now. I think what I've seen at Schwab is at most 0.5%. Not to knock Schwab, they do a great job. But there are some things that if you look under the hood, again, I think you'll see that theme resonating. You know, it's not just about the headline fee. It's not just about the headline inflation number, the headline debt number. We also, in portfolios, use institutional wholesale priced funds. So if you go to a competitor, including Schwab, you're typically paying retail prices. I think you may have heard this example before, but Walmart pays probably $1.99 for a gallon of milk, right? We pay maybe $5.99 for a gallon of milk. So the mutual funds that are in your portfolio, should you choose to use them through Broadway, are purchased at the institutional level, closer to the $1.99. So there's a slew of benefits like that. The fact that we don't have any Broadway mutual funds in your portfolio, because we don't think we can be subjective about analyzing our funds versus somebody else's. So I would encourage you to look well beyond the fee structure.
And the good news is that we travel in pairs, if you will. So no matter what type of your account you have and what type of role Broadway's gonna serve, you always get a Liz and a Kelly, or a Casey and a Mark. So you always have an advisor that's kind of the quarterback of the team that gets your tax documents out, handles your statements, money in, money out, all that fun stuff. And then Kelly, Mark, their team is handling the investments day to day. And the good news is it's all in-house, right? We even do specialty asset management, real estate, oil and gas, it's commercial, it's residential. We're one of the few banks that still have everything in our building. And that's what's nice, because there are bigger banks, which some of us have worked at, where our operations team was in Nevada. So a totally different time zone. I had to wait in the morning to call those people to see where my wire was coming in, that sort of thing. Here, it's right next door at the bank in our admin building. So that's what's nice. And I will make sure Sylvia should have our fee schedules. So there's a published fee schedule. There's a whole bunch of categories on it, again, depending on the type. Real estate has its own fee. Oil and gas has its own fee. But like I said, for the starting point, that plain old investment account or an IRA, it's 1.25% on the first million. And then the more that goes in, the fee will stair step down accordingly. So did that answer the question okay? Oh, coming back here.
Going back to R&Ds, and I'm asking a question and I'm looking for correction if I'm wrong. The R&D that you're going to pay that year is determined in January. And on the amount in your fund at that time. If you take a lump sum at the end of the year, you will have, you'll then have a lower RMD in the following year and 10 months for your fund to recuperate, if you will, from that distribution. I fell into that, and in a venue where returns have been good and have restocked it at most occasions over the last, since I had to take RMDs, I think that's a reasonable process, but I'm curious if I'm not looking at it the correct way.
Casey, do you wanna take that one?
I can, so for RMD calculation purposes, it's nice because we have a system that does that. So it's not myself or Liz sitting there with the calculator, you don't have to worry. So the calculation itself is done on the last business day of the year, right? So that might be 12/30, it might be 12/31. We take a snapshot of that market value as of that day, and then there's life expectancy tables, right, that the IRS kicks out. So there's a percentage and there's your market value, and that's it. There's no wiggle room, nothing like that. So like Kelly had mentioned, it depends, right? I have some clients who want their RMD in March or April because they're gonna pay their tax bill with it, right? Because when that RMD kicks out, you're paying ordinary income tax on it, right? You gotta pay the piper. But some people wanna leave it till December for property taxes. So it depends on, I would think, how the market's doing. If you wanted to leave it in, you can take it however you want. You can take it monthly, quarterly, lump sum, annually. You can tell us, every January we'll reach out to our clients and say, here's your R&D. How would you like to take it? I can give you a check. I can put it into this account, that account. We can do QCDs, qualified charitable, right? Distributions. We do those election forms, but it just depends. If you wanted to leave it in January, I will tell you your R&D is $20,000. You don't have to take that until December of that R&D year. So you could leave it in the account and let it earn money. You take it out, and then you're right, your balance may or may not be lower, right? Your entire market value on which the RMD for the following year will be calculated. But it really is based on need, and I would say market conditions at the time. Some people are I want it in April to pay my taxes so I don't have to, take a chunk out, because you've got to take that RMD out regardless. So I hope that was helpful. Kelly, do you have any additional points? Any more questions? I have a microphone. I'm coming to you.
I prefer the questions that go to Casey, please.
This question is way off of what you've been talking about right now, but I'm wondering if you could address the digital dollar and the fact that their new theoretical goal, or whatever it is the dollar has been moved out of the America to a lot of different countries are buying into that way in which they're going to be funded. I don't know if we want to call it a dollar or what.
I think you're talking about cryptocurrencies, if I'm not mistaken.
It could be, I'm not that knowledgeable. I just know I keep reading these things about digital dollar, and our dollar is going down. No one's using our gold from the different countries.
So there's a difference between cryptocurrencies and a digital dollar. A digital dollar is, in my opinion, a lot like a debit card or traveler's checks or a check you write off of your checking account. It's just another way to spend US dollars. Some people are concerned about that method because the government could track our spending more than they do today, but let's face it, the government could track our debit cards if they really wanted to, so I don't think it changes a whole lot. What is a pretty monumentally big change is cryptocurrencies. That's the Bitcoins of the world that you've probably heard about. Bitcoin is being sold as a currency, but the funny thing is you can't use it in a lot of places yet. It's really more of a speculative investment. I don't even like to use the word investment with it because it's so speculative. It's like gambling. Gambling isn't investing. People have made a lot of money with some of these cryptocurrencies, and it's basically sending money online. Like when you send an email, you have a copy of that email in your outbox, right? And the recipient has a copy of that email. But when you send money, that can't be the case. You can't have another copy of that dollar in your inbox. It's got to go to somebody else. And the beauty of Bitcoin and cryptocurrencies is that they figured out the technology to make that happen. So there's only one Bitcoin or crypto dollar or what have you. So it helps a little bit with regard to authenticity. There's a lot of uses for this. Some people thought it was gonna be the next artificial intelligence, but the fact of the matter is, cryptocurrencies have had a tough time really getting up and getting past certain levels. So Bitcoin, for example, is trading around $61,000 per Bitcoin right now. It's gotten up as high as 70,000, but really getting past 65 and staying past 65 hasn't really happened. So the jury's still out on this technology, but I would think of it as nothing more than really a technological advance.
So the fact that they're saying that with the digital dollar, they can close your account, take your money out, not be able to do anything with it. If you give money to a charity or something like that, you can be penalized. That's just all fabrication or
Well,
reality?
Could they take your money now? I mean, I guess conceivably it's possible, but practically it's inconceivable because it would be Armageddon. So, you know, anything's possible. There could be a nuclear bomb that's dropped in San Antonio this afternoon. But I think a lot of that is just fear mongering and edutainment, meaning people want to get you to click on their headline, and so they deliver the most radical thing that they can think. So I would be shocked. If there's a situation where the US government is expropriating assets, no matter how they do so, we've got problems way bigger than a digital dollar.
Last question. Do you foresee in the future about banks failing like we had back in '08 coming down the road? And where does Broadway Bank fit into how strong it is for being solvent and being able to handle a crisis like that in the future?
Kelly, I can speak to that a little bit, or?
Yeah, well, this was a big question last year, and I thank you for addressing this. Banks take deposits, that's how they generally fund themselves, and they invest those in two things. They invest them either in loans for companies to grow their business, or they invest them in financial assets. What happened with the regional bank crisis just a year ago was that the prices of bonds had jumped around so much, like we were talking about, that the safe piece of the bank portfolio at Silicon Valley Bank was worth a lot less than it had been in the past. And social media had said, oh gosh, you know, they might have some problems, so people pulled all kinds of money out there. And if you did the analysis, it was the banks that had the most un-FDIC insured deposits that went down the fastest. So number one was SVB, Silicon Valley Bank, and then there was First Republic, and it was just almost rated order. So what happened in 2008 was very different because it wasn't the bond piece of the portfolio the banks were having trouble with, and the Fed stepped in and guaranteed that they would give banks 100% of what they invested. So that issue has completely gone away. In 2008, banks were making loans that they probably shouldn't have. So it was on the loan side, the credit side of the bank. That's always a risk. So it matters where you put your money, but I would say what happens in a wealth management portfolio like we're talking about here is that you don't have a single penny exposed to Broadway Bank. So Broadway could close its doors tomorrow, heaven forbid, but not 1 cent of your portfolio would be at risk because there's not 1 penny of Broadway Bank exposure in your portfolio. And that's for regulatory reasons, it's for strategic reasons. So while you don't want a delay of a day or two in getting access to your portfolio, there is no Broadway Bank risk in these portfolios. And that's not the case with some of the other things you may invest at elsewhere. So something to keep an eye on. Now, from a bigger picture perspective, no one's policing the banks like they used to. You know, it used to be that there could be a run on banks like in the 30s, so to protect against that, banks would keep more of their money liquid, less in illiquid loans. Well, with the government coming in, there's this moral hazard now. So banks can kind of do what they want in some cases, certainly the big banks. Broadway Bank's not gonna get a bailout from the US government, but the big banks are potentially taking a few more risks than they need to, because if there's that backstop, that government program where the government will just write a check and keep banks afloat, then we don't have that same check and balance mechanism that we've had in the past. So, you know, again, when you're going to the polls, think about that and think about the policies that your candidates espouse for that. I think there was another question.
I've got one more and then we will do our raffle and let you guys out of here.
What do you think of the recent Supreme Court decision that let the camel's nose under the tent as far as wealth taxes?
I am not familiar with that.
The Supreme Court made a decision recently that indicated that wealth taxes were not beyond the scope of Congress's capability to tax. E.g. unrealized capital gains could be taxed the same as realized capital gains.
So at the risk of showing my hand here, I'm in favor of fewer taxes versus more. However, the estate tax was implemented many, many years ago, and it represents a very small piece of the taxes that the federal government brings in, 1 or 2% at best. So it's a de minimis form of revenue. But the reason they implemented it was not just take people's money, it was because families like the Rockefellers and the Vanderbilts were exceptionally wealthy. And if there wasn't an estate tax, it would be the Rockefellers and the Vanderbilts that were running this country into infinity. So in order to kind of even things out a little bit and make sure that we didn't have a small minority that became overly influential, they put this estate tax in place. So there's been a conversation about it for a long time, about whether it makes any difference, whether it moves the needle, whether it's just taxing the wealthy. Again, I would say, illustrate your opinion at the polls, if that's diplomatic. I appreciate you being here today.
Yay, let's give Kelly a big round. Sorry, I didn't mean to interrupt you.